Have you ever heard someone say, "My business made 10 million rupees this year," and immediately assume they're rich? Well, here's the surprising truth. A business can generate millions in income and still lose money. In fact, many businesses with impressive sales numbers quietly struggle behind the scenes. So what's the difference between income and profit? And more importantly, which one should you actually focus on? Let's break it down. At first glance, income and profit seem like the same thing. Money comes in. Business is doing well. End of story. But in reality, they're very different. Think of income as all the money that enters your pocket. Profit is the money that actually stays in your pocket after you've paid all your bills. One measures activity, the other measures success. Understanding this difference can completely change how you look at business, investing, and even your own personal finances. Let's start with income. In business, income usually refers to the money earned from selling products or services. If you own a bakery and sell cakes worth 100,000 rupees this month, your income is 100,000 rupees. Simple. Income tells us how much money is flowing into the business. It's often called revenue, sales, or top-line income. A growing income is usually a good sign because it means customers are buying what you're selling. But income alone doesn't tell the whole story. Why? Because earning money is only half the equation. You also have to spend money to make money. That's where profit comes in. Profit is what remains after all expenses are deducted. These expenses may include rent, salaries, electricity, raw materials, marketing, taxes, and many other costs. The basic formula is profit equals income minus expenses. When profit is positive, the business is making money. When profit is negative, the business is losing money. This is why profit is often considered the real scorecard of a business. It's not about how much comes in. It's about how much stays. Let's look at a simple example. Imagine two shop owners. Shop A earns 1 million rupees in monthly income, but its expenses are 950,000 rupees. That leaves a profit of only 50,000 rupees. Now look at Shop B. It earns only 500,000 rupees in income, but its expenses are just 350,000 rupees. That leaves a profit of 150,000 rupees. Which business is actually performing better? Most people would initially choose Shop A because the income is higher, but Shop B is making 3 times more profit. This is one of the biggest mistakes people make. They confuse big sales with financial success. Think of income as water flowing into a bucket. Expenses are holes in the bucket. Profit is the water left inside after some leaks out. You can pour huge amounts of water into the bucket, but if the holes are too large, you'll still end up with very little. The goal isn't just to increase the inflow. It's also to control the leaks. This distinction matters everywhere. Business owners need profit to survive and grow. Investors often look at profit because it shows whether a company can generate real value. Banks examine profitability when deciding whether to approve loans. Managers use profit figures to evaluate efficiency. Even in personal finance, the same principle applies. Your salary is like income. What remains after rent, food, transportation, and bills is similar to profit. A person earning 300,000 rupees per month can end up saving less than someone earning 150,000 rupees if their expenses are out of control. Income creates opportunity. Profit creates wealth. One common misunderstanding is believing that higher income automatically means greater success. Not necessarily. A company can double its sales and still become less profitable if expenses rise even faster. Another mistake is focusing only on cutting expenses. While controlling costs is important, a business cannot grow by cutting forever. The healthiest businesses increase income while managing expenses wisely. The goal is balance. So what should you focus on? If you're trying to grow a business, pay attention to both. Income tells you whether the market wants what you're offering. Profit tells you whether your business model actually works. If you're an investor, don't be impressed by revenue numbers alone. Look at profitability. If you're managing personal finances, don't just focus on earning more. Also focus on keeping more of what you earn. Remember, it's not what you make, it's what you keep. Income gets the headlines. Profit builds the future. Income shows movement. Profit shows progress. A business with strong income but no profit is like a car with a powerful engine but an empty fuel tank. It may look impressive for a while, but eventually it stops. So the next time you hear a company boasting about huge sales, ask a smarter question. How much profit did they make? Because in the world of finance, business, and investing, profit is where the real story begins. Income creates opportunity. Profit creates wealth. Focus on what you keep, not just what you earn. If you enjoyed this video and want more simple explanations of finance, business, investing, and economic concepts, make sure to like this video, subscribe to the channel, and hit the notification bell. Thanks for watching, and I'll see you in the next explainer.